If you decide to start day trading in 2026, the statistics say you will likely lose money for the first 3 years of your journey. Most beginners spend those 3 years obsessing over chart patterns and trading strategies, completely ignoring the environment they are actually operating in. Your choice of financial market dictates your mathematical baseline for survival. You can master every technical indicator available, but if you operate in a market structurally designed to bleed your capital, you will fail. This bleeding effect comes from something called structural friction. It is the combined weight of high taxes, brokerage fees, and low available leverage. This animated scale shows how friction directly impacts your survival. In a high-friction environment, heavy costs mean you must win significantly more just to break even. Even placing small winning trades on the efficiency side, that massive friction block barely moves, leaving a negative account balance. To escape this mathematical trap, you have to look outside familiar domestic markets. Choosing where to trade is a pure equation of survival. For most retail traders, it comes down to a direct comparison: the Indian stock market versus the global forex market. This matrix breaks down how these markets compare. The Indian market shows high safety, but extreme structural friction. Taxes and fees pull heavily at margins, and leverage is low. Forex offers minimal friction and massive capital efficiency, but operates without domestic regulatory safety. Trading domestic Indian equities is like opening a restaurant in a small village. Your absolute growth is permanently capped by a low population and high overhead costs. Forex, on the other hand, is like opening a business in a global metropolis. The volume and potential are massive and unconstrained. Forex gives a small account a necessary scale and low friction to actually grow, but that efficiency demands a dangerous trade-off in security. When you choose Forex, you are explicitly trading structural friction for extreme counterparty risk. You have to use an offshore broker. They act as your mandatory intermediary, holding your capital and giving you access to trading platforms like MetaTrader 5 or TradeLocker. The reality of this offshore ecosystem is chaotic. Scams, frozen withdrawals, and platform manipulation happen every single day. This brings us back to the domestic market. Those high taxes and fees are literally the price you pay for legal safety and regulated intermediaries. In Forex, you can execute flawlessly on the charts, but if you fail to rigorously vet your offshore broker, your theoretical profits mean absolutely nothing. Once you secure a reliable broker, you have to survive the actual trading. Beginners usually fall into an over-knowledge trap, memorizing dozens of retail chart patterns that rarely work. Instead, there is one core technical concept you must master to survive modern markets: liquidity. Look at this price chart. The glowing areas represent retail liquidity, usually beginner stop losses. Institutional players drive the market here to fill massive orders. Watch this support line completely break as price dives to sweep the liquidity pool, trapping everyone. Surviving Forex requires an institutional perspective on the chart, identifying exactly where the money is resting. Before you risk a single dollar in these environments, you must follow a strict validation protocol. Step 1 is isolating your risk entirely by opening a demo account. Next, you run a 1-year backtest. You apply your strategy to 12 months of historical data to gather hard, emotionless proof of whether or not it actually works. This flowchart maps the required path. After the demo account and the 1-year backtest, your strategy must cross a strict threshold, an 80% theoretical win rate. Notice the 20% drop-off mapped here. When you move to live markets, variable conditions and your own psychological pressure will degrade your execution accuracy. You need that initial 80% buffer just to land at a profitable 60% win rate in reality. Spending months backtesting is the only mathematical way to insulate your limited capital from world variables. With limited capital, Forex is the mathematically optimal path to escape domestic friction, provided you can maintain extreme discipline and aggressively vet your brokers. Once you prove your consistency, you can transition to prop firms. These allow vetted traders to leverage institutional capital, meaning you take a share of the profits without risking your own savings. However, if you know you cannot stomach offshore counterparty risk and the intense vetting required, you must avoid Forex entirely. If you need peace of mind, you have to accept the high friction of domestic Indian equities as a necessary, mathematically sound business expense. Long-term survival requires matching your specific capital constraints with the structural reality of the market you decide to enter.